Welcome back, everybody, and welcome to another episode of the Investors Digest Market Forecast and Update. Got a little bit of a special episode for you this month, as I was asked to kind of do a little bit of a market forecast. Since it's a data, I'm kind of the market update guy that's been consistently doing these here for several years here in San Antonio. So, the Ala Maria here in San Antonio asked me to put this together, to say, put a little bit of forecast together. What are the things that we were seeing? And we just so happened to attend an economic forecast by an economist out of the Texas A&M University. So kind of pulled some of the stuff from his slides and then did a little bit of my own research to kind of really see and give my opinion on where we're currently at in the San Antonio market and nationally as far as an economic standpoint. Are we good? There's a lot of talks that we've been going up for a while. We're on the verge of next recession, and a lot of stuff with this now new coronavirus coming out. Where do we currently stand to kind of ease a little bit of fears a little bit in the market? So we'll go ahead and kind of jump that in. So what we're looking at, it'll change. There we go. Jobs, and even more jobs. You look at where we've historically been, or not historically been, but where we're currently sitting at as far as the number of jobs that we're currently adding to the market. At a very rapid rate, we're adding a lot of jobs. You can really see here in the 2008 how they were laying off a lot of people month over month. But coming out of the recession, we came back strong, and we've really been holding strong for the last couple of years. So when people are getting jobs, adding jobs to the economy, that is fantastic. The economy is expanding. There's more money flowing throughout the economy. The velocity of money is turning over. You'll see that here in a little bit when it comes to the consumer confidence. Was another big key economic indicator is if people are spending money, they feel confident in the economy. So that's fantastic to see that this data is a little old, but we had 266,000 jobs in November, and I think we went gangbusters in February this last year too, of really blowing out of the water what the economists projected that we were going to add. So that is really good news that obviously companies feel confident and they are currently hiring employees. So now what's even better than jobs? Even more jobs. Now what we're looking at here is the level of job openings in the U.S. So you can see that we are at an all-time high of the last two recessions by a very large margin of the number of job openings here in the United States. So that is fantastic. Not fantastic. It can be a detriment to the economy if they're borrowing money to invest it and they can't find the people to work it to really expand their businesses. But it does show that there is plenty of job openings. That here you can see in the last recession how we really tanked down into the low 200,000s, but now we're well up into the 800,000 number of job openings here in the United States. So that is fantastic that obviously companies are trying to hire, they're adding jobs, they're really trying to expand their businesses. So that is great for the economy that we're trying to expand and people feel good about it. So another thing that really drives these things is the consumer confidence. Our end consumer, us, our general people, how do people feel about the economy? So now this is 2006 to really the present. And you can really see we feel better about the economy now than we did back in 2000 before the last recession. So that is fantastic news. So when people feel confident about the economy, they go out and spend. They go out and invest. They go out and they buy cars. They buy clothes. They buy investments. They see the economy doing well. So they are feeling great about it. So they go and spend. So that is a really good thing that the end consumer, us people, are feeling good about the local economy. Another thing that goes along with that is the household debt service ratio. So it really shows that we still have a lot of fuel. And this is, meaning is the, how to describe it? The amount of disposable income that you have that goes towards debt servicing ratio, if that makes any sense. But you can really see that going back clear back before 1985, we are at the lowest amount. This means that we have a lot of fuel to burn to where if interest rates start rising, housing gets more expensive, credit card payments go up, cars interest rates get a little more expensive. We have a lot of room to where it really starts historically affecting the end budget of the end consumer. So that is great news, and that's no surprise with our historic interest rates. But everyone says, like, well, if they start raising interest rates, we're screwed. The end consumer's screwed. Not necessarily. According to the historical data, we have quite a few percentage points that this can rise to really make a difference. And the great thing about, especially here in San Antonio, is if people are, what kills real estate more than anything is if you have an exodus of population. You have more people leaving than you have coming, because that means you have more housing than people want. But you look here in San Antonio where we sit in 2010, 2015, 2020, and projected, look at this job growth. About every 5 years, we're adding 300,000 people to our market. In 20 years, we're going to almost double our population. That is fantastic for the local real estate market. When people are moving here, that means we have older housing that needs to come on the market. We have builders that are building here to supply that demand, and builders just can't build houses fast enough. In our business, we're building houses, and it's taken us over a year just to break ground on property because of the permitting process and the red tape that we have to go through. So that is taking a long time to get new housing stock on the market, but now that allows us renovators and rental and landlords to provide housing as a gap of the shortfall for where the builders are falling short. So that is fantastic news for here in San Antonio, what we're looking at. Some areas of concern that could potentially be a problem that we're kind of watching, or I'm kind of watching, is the rising federal deficit. And it's no surprise, I think we just crossed over $1 trillion a year that we're short in our budgets. And everyone's saying that the deficits can't rise forever. And I agree, but at what point does it really start to affect the local economy? Nobody knows because we've never been here before. But it seems like everyone around the world, the U.S. especially, is loving just printing that money and putting it through into the economy, and there haven't been any real repercussions of that as of yet. But it's something to continue to watch because there's no data on it. We don't know if it can rise forever or if it's just a fictitious number that really doesn't matter. Some people argue that the deficit really doesn't matter. Some people say it does. Yet, well, a future will tell. The rising corporate debt levels. So with these historical low interest rates, companies are borrowing money and turning their debt over at very large quantities. So that debt is rising, like we were talking about with these job openings. So if a company goes and wants to make a big expansion into something new, and they go borrow a whole bunch of money at a very low interest rate, and they go to plan to hire 10,000 people and they can't find people to hire, that could potentially have a negative impact on their business because now the expansion they were wanting to do failed, but they still have to pay off all that debt. So if interest rates do start to rise and we have all this debt and some of this stuff is borrowed on short term, and now that debt gets more expensive and they don't have the cash flow to supply it, that could hurt our corporations and the corporate debt market and could cause problems. And that leads right into the near zero interest rates that they're borrowing a lot of money. People are borrowing money, and those interest rates start to rise. While the end consumer has a lot of dry powder, the corporate America does too. But if that continues to go and really squeeze, that can cause problems. The affordability factor that a lot of housing especially is really kind of getting very expensive, where wages aren't rising at the rate of some of what I call, I believe is in like your core inflation numbers as far as housing, especially housing, that we're rising at a 6-7% year over year rate, but wages are only going up at 2-3%. So that can't go on for very long before you really don't have anybody that can afford those houses. So if prices have adjusted to the market of selling to that market of the high prices, but nobody can buy, that's going to put a squeeze and make prices have to come down, but that can come into problems when you have near zero interest rates and big corporate debt. So the 2020 motto is we're growing, but we're slowing. And you can kind of see that in the stuff I've been talking about for quite some time in these market reports. So with that, we'll go ahead and get into the normal programming, as I guess you could call it, for the market report. The average sales price here in San Antonio rose to $267,792, which is just shy of an 8% increase year over year. Median sales price is up to $217,500, which is an 8.8% increase year over year. So that's what I was talking about, that wages are only rising at 2-3%, but median sales prices and average sales prices are rising at 8-9%. That can't go on forever before you start pricing people out. Total sales was 2,078, which is a huge 15.9% increase from this time last year. Average rental price up to 1470. Now, keep in mind, last month we were flat at 0% increase year over year, but this year we're sitting at 4.6%. Employment is just shy of 1.2 million, which is a 2.59% increase year over year. We lost a few jobs, 1135. I'm not really worried about that kind of job loss when we're talking an employment of almost 1.2 million people. Unemployment rate decreased to 2.79, so that is fantastic. That is lower than the Texas average, and that is lower than the national average of having an unemployment rate of 2.79. So that is good that we have a lot of people employed here in San Antonio. Excuse me. Months of inventory sitting at 489. And now some people ask me the question of like, well, isn't that kind of bad? Isn't that showing the market slowing? No, so that's why I added in here that this February 2019 was a 5.55, so that was almost a balanced market right there. So we are 1.35 month increase now from this time or from the previous month. So we have more inventory on the market, but this is pretty typical for this time of year, and we are at a lower months of inventory than this time last year, so that is good. Now remember, months of inventory is our gauge as real estate investors as what is the health of the market. Are we buyer market or seller market? 6 months of inventory is a balance between buyer and seller. Anytime we drop below 6, it becomes more of a seller's market. That means there's yes, it's more of a seller's market. The seller has the negotiating power. There is more buyers than there are sellers, so there's more competition for housing, which can push prices up, and you don't need to give as much in concessions or do as much in repairs or as big an update on property. Now this is the median sales price over time, and if this is your first time really checking in, you're looking at your market cycles. So prices up in the summer, down in the winter, up in the summer, down in the winter, and you always get a little bit of activity down here coming December, heading into the new year, as you get a bit of a price spike of everybody trying to close those loans, get in the houses for the new year. So you'll see a drop of months inventory, you'll see a little bit of a tick up in price, and days on market will kind of drop and adjust to that as well. So this is something that we definitely use in our business as to when we're trying to pick up property. Like right now, as like we're trying to buy everything we can. Come like November, December, January, February, March, even into March, a little bit into April, we want to buy property. We'll buy property all the time, all throughout the year, but we really want to load up on that inventory now because I'm going to be listing my properties in April, May, June, and July, which is these hot months right here when you have a lot of buyers buying and taking off or trying to get into the market and looking to buy houses. Monthly rents follow the same exact thing. Up in the winter or up in the summer, down in the winter, up in the summer, down in the winter. So for us, we definitely always hold our rental properties, no matter when a tenant moves out or when we acquire a new rental property, we always make the leases end in the springtime. We had a little bit of didn't quite think it all the way through as we had all of our leases ending March 31st. Well, all of a sudden, we had 3 people move up to go buy houses, and they all ended at the same time, which made me very busy all of a sudden trying to get properties ready to go, get them rented, and get them back on the market, and get new tenants in there. So now we've adjusted to where making all of our leases ending in March, April, and May, so we still catch this springtime, summertime jump in rents, but we also get it doesn't all end at one time. So that makes it fantastic for that aspect. So something we've changed recently. 20-year unemployment. This is why I wasn't worried about a little bit of a job loss, but our unemployment rate is such a low rate. Now, if I saw this gaining 1,000 to 5,000 or up 3%, up 4%, and it started really climbing year over year, 0.5%, because you can really see, and this is why I track this, is our real estate prices didn't bottom out till the summer of 2011. But we spiked within a year of unemployment. So recession started around 2008. By 2009, unemployment had reached its peak, but real estate didn't bottom out till 2011. That's why I follow these things, because if people are getting laid off, unemployment's rising, people aren't being hired, wages aren't going up, the consumer confidence is going to fall, and you're going to see that roll over into the real estate market and into the debt market and mortgages and stuff. So that is why I track this stuff, is to kind of look in the best I can into the future of where we're currently at, or if there's something on the horizon that we really need to be paying attention to. So the overall, so this is my year over year appreciation. So this is where I was saying like 2011, 12 is when we stopped going down in price and really kind of came back up. Now I kind of had been saying that, and it kind of still does show that we are slowing down in the average appreciation. So over the course of the data set you see here, the total average is 5.2% year over year appreciation. But I tracked the 12-month average and we're sitting at 4.5%. So I was saying you can kind of see a downward trend right here, but this last month we really kind of shot back up to over 8% year-over-year appreciation again. So we'll see if that continues or if that's just a spike like we've gotten in the past, but things are kind of slowing down. My take is we are slowing down because, like I said, wages have been going up at 5.5%, almost 5.2% year-over-year average, and wages have not gone up that much. Even with new job creation, if wages don't increase, we lose some of that ability for people to afford housing. So now the question becomes, where do we market? Find the best. Our thing is we all go off months of inventory as far as price range and location for our rental properties and our renovations. So now where do you market to find those little pockets inside San Antonio? Like I mentioned, we do it by two ways. We do it by price range and by zip code. First up here we have the price range. And I remember we had, what was it, 2,000 houses being sold here in San Antonio? And look at where the bulk of these have been sold, between that $150,000 to $300,000 price range. This has shifted. This used to be the $100,000 to $200,000 price range, but it's really moved up. And with it, our business strategy has moved up as well, that now we are looking for renovations in the $250,000 and under, where it used to be just $200,000 and under. Now for our rental properties, we try to pick everything up in the $200,000 under price range, because that is where we're seeing the greatest leaps and bounds of appreciation. And also it is the most demand, with, you can see here, the months of inventory. Remember, the lower the numbers goes, the more in demand that housing is. The higher it goes, like you get up here, the less in demand it is, because so these higher price homes in the 350 and up is already in a buyer's market. The buyer has a lot of choices. They have things to choose from. They have inventory across the city to go look at property. And while there's not as many of them, so you can really kind of pick and choose where it is that you want to go buy. Now, the other way I do this is by zip code. Where's the best zip code for as low months of inventory, and what is the average price point? It's a little weird to see something this pricey clear up at the top. That's kind of an anomaly. That's the first time I've seen something really above into the 200, above 250 price point being the most in-demand zip code, but that's what the data said this month. So I really do illustrate where we were at 3 years ago, so you can see and really illustrate what does that low months of inventory mean. 250, 251, they've really always been in the top 10 because they're very desirable areas and they've been traditionally affordable. And you can really see what has it done from the last 3 years to today, having that low months of inventory. And we've gone from 144,000 average price in February 17 to 174 in February of 2020. So that's a 30,000 price increase in just 3 years. That is phenomenal. So if you had a rental property, even if you paid full price for it in February 17, you've had some equity pay down, hopefully some cash flow, but you've gained 30,000 in equity just on pure price appreciation. So that is fantastic. And if anybody is listening to this, watching, wherever you're tuning into this, wants the full list, shoot me an email at john@prymehomes.com, and I can send you over the full list so you can see where your properties, your renovations, or your marketing strategy tailors to that list based on these months of inventory. Now, the flip side of the lowest months inventory, where is the highest months inventory? Not to say these are bad areas, because you can see right here you still have massive appreciation in a 3-year time span, even though you have high months of inventory. But I think a lot of that is due to the price point of being at a lower price point, like here you see at 78224. But what you can really use this for is your competition level. So if you are renovating in an area and you pull and see that you have high months of inventory, and what you really determine that by is if no new houses were listed on the market and the same pace of houses sold, how many months would it take for all the inventory to be consumed? So in 78202, if no new houses were listed and the same number of homes sold in that sold in February continued, it would take 12 months, a year, for every house to be consumed. That's a long, long time. 6 months is your balanced market. If it's a high month or higher days on market, you're more buyer oriented than you are seller. So to really use this stuff, you use it as in, if you got high months inventory, is maybe spend a little more money, especially if you have a big you're flipping into somewhere like the 78163 and it's a $350,000 house. Spend a little more money in the kitchens, the bathrooms, the landscaping, the pictures, the staging, to make sure that your house is the nicest one on the block, so it's the first one to go. Find a real estate agent. If you're listing a house, go look at your competition, walk through, see the level of finish out. What are you working with as far as the type of materials that are being used? And don't be afraid to update that and try to spend more to get that stuff done. Because if you're paying a $3,000 a month interest payment, every month you cut that check, that is straight out of your bottom line. So if you can spend an extra $5,000, $10,000, but you sell in 1 month versus 11, you save yourself $30,000 in interest payments right there. So that's worth it to do it. So keep that stuff in mind. With that, that concludes this month's episode. Like I mentioned, depending on where you're tuning into this, if you're listening on the Investor's Journey podcast, head over to prymehomes.com or over to YouTube and search for market trends in San Antonio to get a visual walk along of the information we're talking about, not just the audio, so you can see some of these graphs, what these numbers really mean, because it's very hard to picture this stuff when I'm just spitting a lot of numbers at you. It's very hard to do. So if you are listening to this on YouTube or through our newsletter, definitely tune in to wherever you get your podcasts and tune into Investor's Journey, where I put the market updates on there every month, and John does a weekly podcast about things we're doing in our business, tips and tricks of how you can make yourself a better investor from the mistakes that we have been making. That's why we call it our Investor's Journey. So as we go learning things, we go and putting it out there to the world so people can learn the same lessons we do without having to learn it the hard way like we have. So hit us up on social if you're very active. Otherwise, we'll catch you guys next month.